Morning, everybody. The June 19, 2018 School Land Board meeting will now come to order. First item on the agenda is approval of minutes from our last meeting on June 5, 2018. After the board has had a chance to review the minutes and assuming no questions, comments, or concerns at this time, could entertain a motion to confirm said minutes.
Motion to approve.
I'll second. Motion is made, seconded, and carries unanimously to approve the minutes. Next item on the agenda is the approval of the consent agenda as posted. I've been briefed that there have been no last-minute changes to the consent agenda, so after the board has had a chance to review and assuming no questions, the consent agenda can be approved.
I move for approval.
Second.
Motion is made, seconded, and carries unanimously to approve the consent agenda as posted. Items number 3 and 4 will be held in executive session. We will enter executive session pursuant to Chapter 551, Subchapter D, Section 551, Tech 071, the Texas Government Code for discussion and consideration regarding pending or contemplated litigation and/or settlement offers to seek, receive, or attorney advice or counsel related to items 3 and 4 on the docket, and subsection 551, Tech 072 for the discussion and consideration concerning purchase, sale, exchange, lease, or value of real property related to items 3 and 4 on the docket. Following executive session, we'll reconvene in open session to complete the agenda. The open session of the June 19, 2018 School Land Board meeting will now resume with item number 3.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer. Approval of this agenda item would constitute your approval of an investment by TexGlow on behalf of the Permanent School Fund in Global Energy and Power Infrastructure Fund 3 LP, which I'll refer to as GPIF 3. The IAC is recommending that TexGlow invest $200 million on behalf of the Permanent School Fund in GPIF 3. As a reminder, GPIF 3 is a $3.5 billion closed-end commingled energy infrastructure fund sponsored by BlackRock, Inc., and it's a follow-on to the 2014 vintage $2.5 billion GPIF 2 and the 2011 vintage $1.2 billion GPIF 1. BlackRock, as you know, is the world's largest publicly traded investment management firm with approximately $6 trillion in assets currently under management. GPIF 1 and 2 were originally sponsored by First Reserve, but BlackRock acquired the GPIF platform from First Reserve in early 2017. The GPIF funds are now managed under BlackRock's Real Assets Group, which manages approximately $14 billion in client assets. GPIF 3 will continue to build upon the strategy utilized in Funds 1 and 2 by focusing on building a globally diversified portfolio of investments in the energy and power infrastructure sector, located primarily in countries that are members of the OECD. We have a long-standing relationship with the GPIF team that began in 2009, and it's resulted in total capital commitments of $225 million in the 2 previous GPIF funds, $100 million in Fund 1 and $125 million in Fund 2. Investment management staff and the Townsend Group conducted due diligence and analysis on GPIF 3 through comprehensive document review and a series of meetings and discussions with the GPIF team over the past 6 months. In addition, a detailed presentation was made by the GPIF team to the IAC and Townsend on May 14th of this year. In conjunction with this discussion, review, and analysis, Investment Management worked with Townsend and legal counsel to ensure that the proposed investment fits within the framework of the TexGlow Permanent School Fund Real Assets Investment Policy Statement and is in the best interest of the Permanent School Fund. Therefore, the IAC is recommending the School Land Board approve a $200 million commitment in Global Energy and Power Infrastructure Fund 3 LP. I'm happy to answer any questions. I would also point out that the approval of this transaction, as always, is contingent upon Investment Management's completion of the negotiation and finalization of the legal documentation associated with the proposed investment in GPIF 3. Happy to answer any questions.
Any questions?
No questions. I move to approve.
I'll move to second. A motion is made, seconded, and 1 abstention. Mr. Burciaga will recuse himself from the vote to approve item number 3. Next item on the agenda is number 4 as stated.
Thank you, Mr. Chairman. Members, approval of this agenda item would constitute your approval of a co-investment by TexGlow on behalf of the Permanent School Fund alongside Global Energy and Power Infrastructure Fund 2, which I'll refer to as GPIF 2, through a newly created limited liability company co-investment vehicle called Capital Co-Investments 16 LLC. The IAC is recommending that TexGlow co-invest up to $125 million alongside GPIF 2 through Capital Co-Investments 16 LLC. As some background, we have a long-standing relationship with the GPIF team that began in 2009 and resulted in a $100 million capital commitment to the 2011 vintage Global Energy and Power Infrastructure Fund 1 and a $125 million capital commitment to the 2014 vintage GPIF 2, both of which are closed-end commingled funds sponsored by BlackRock, Inc. that focus on building globally diversified portfolios of investments in the energy and power infrastructure sector. The GPIF team has recently identified a very attractive co-investment opportunity. For GPIF 2 in the midstream energy space, it requires capital in addition to the amount that will be committed by GPIF 2 itself. Therefore, it has selected a select group of potential co-investment partners from within the pool of GPIF 2 limited partners to participate in the transaction. Investment management staff conducted due diligence and analysis on this co-investment opportunity through an analytical review and a series of meetings and discussions with the GPIF team over the past 4 months. In addition, we also discussed the proposed co-investment opportunity with W.D. Von Gatten and Associates, a premier oil and gas consultant located in Houston. The GPIF team then made a detailed presentation to the IAC and the Townsend Group on May 14th of this year. In conjunction with this discussion, review, and analysis, investment management and the IAC have determined that the proposed co-investment fits within the framework of the TexGlow PSF Real Assets Investment Policy Statement and is in the best interest of the Permanent School Fund. Therefore, the IC is recommending that School Land Board approve a co-investment of up to $125 million in the proposed transaction alongside GPIF 2 through a newly created limited liability company co-investment vehicle called Capital Co-Investments 16 LLC. As always, the approval of this transaction is contingent upon investment management's completion of the negotiation and finalization of the legal documentation associated with the proposed co-investment, and also the approval of this transaction also includes the authorization for the formation, activation of the limited liability company co-investment vehicle entitled Capital Co-Investment 16 LLC. I'm happy to answer any questions.
Any questions this time?
No questions at this time. I move to approve.
I'll second. Motion is made, seconded, and carried with one abstention. To approve item number 4, Mr. Borsiaga will recuse himself from the matter. Next item on the agenda is number 5, as stated.
Thank you, Mr. Chairman. Members, I'm pleased to present to you the quarterly investment report of the TexGlow Permanent School Fund investment portfolio for the period October 1st through December 31st, 2017. This is a non-action item for information only. I'll point out that the performance measurement calculations and all statistical data that are in the report were prepared by State Street Bank and its Private Edge Group, which are the custodial, accounting, and performance measurement agents for the portfolio. I'll start off with a market summary, but before I do get into the numbers, I do want to point out that there was a recent restructuring within the TexGlow Financial Management Division that resulted in the transition of certain duties related to the accounting for the internally managed portion of the overall portfolio from the Revenue Administration team to the Financial Reporting team. Upon the preparation for the transition of these duties, some assumptions related to the accounting for the internally managed portion of the portfolio were identified that may require further analysis by the Financial Management team. The internal portfolio portion of the overall portfolio is only a small portion, has a minimal impact upon the overall portfolio performance. Therefore, beginning with this report ending December 13, 2017, the quarterly investment reports will present information only on the externally managed portion of the portfolio as that accounting review process progresses. Having said that, looking at the fourth quarter, as you may recall, U.S. GDP increased at an annual rate of 2.9% after increasing 3.2% in the third quarter, and the unemployment rate ended the quarter at 4.1%. Also during the quarter, the FOMC raised its target Fed funds rate from 1% to 1.25%, up to 1.25% to 1.5%. That was at its December 2017 meeting. They also continued to tweak their balance sheet in what they're calling a normalization program, and it really concerns the reinvestment of principal payments from its holdings in agency mortgage-backed securities and the rolling over of maturing Treasury securities. So in October of 17, they began rolling over at auction the amount of maturing securities that exceeded $6 billion each month. And they also started reinvesting in agency mortgage securities the amount of principal payments from their holdings of agency debt and agency mortgage-backed securities that exceeded $4 billion during the month. At the December meeting, they kept that normalization plan in place, but they raised the targets to $6 billion, from $6 billion to $12 billion on maturing Treasury securities, and from $4 billion to $8 billion on the reinvestment of maturing agency mortgage-backed securities. They also expect that economic conditions are going to continue to evolve in a manner that warrants only gradual increases in Fed funds rate. Thus, according to them, Fed funds rate will probably remain below levels that are expected to prevail in the long run. As far as the sectors that we invest in, the U.S. commercial real estate market, as measured by NPI, returned 1.8% for the quarter ended December 31st. Its trailing one-year return was 6.98%. A decent year, but still it reflects a retreat from what I would call a torrid average annual return of 10.3% for real estate over the past 5 years. So in a nutshell, we are beginning to see real estate as an asset class slow down somewhat as far as returns are concerned. Industrial was by far the best performing sector. It returned 3.28% for the quarter. That's primarily reflecting a really strong demand that continues for warehouse space for online retailers like Amazon. The gross returns for all the sectors were hotel was up 0.96%, retail was up 1.27%, apartment was up 1.62%. Office was up 1.65%, and as I said, industrial, a whopping 3.28%. Moving to the energy markets, WTI spot oil prices fluctuated between $50 to $60 a barrel, and they ended the quarter at $60.46 a barrel, which was a 17% increase from the third quarter ending price of about $51.67. Those prices were primarily influenced by improving supply-demand fundamentals, characterized by several things, including OPEC's strict adherence to its production quotas, stronger global crude demand growth throughout 2017, which is about 1.5 million barrels per day year over year, mostly from emerging markets. Also supply outages from Libya, Venezuela, and Nigeria, and continued Middle Eastern geopolitical risk. U.S. oil production recently topped 10 million barrels per day. That was a level that was last seen in 1970. And the IEA notes that surging U.S. oil production is expected to represent 80% of the expected 1.7 million barrels per day of non-OPEC supply growth in 2018. Natural gas spot prices spiked at the end of the quarter, which is not unusual. It spiked to 369 a million BTUs, but they averaged about 291 million BTUs during the quarter, slightly below the third quarter ending price of 294. Most analysts continue to think that rising industrial demand, LNG exports, increased exports to Mexico, and continued coal to gas switching will foster medium to long-term supply-demand support. However, there is an upcoming wave of infrastructure build-outs in the Appalachian Basin and substantial amounts of associated gas related to the ramp-up in domestic oil drilling that are probably still going to reinforce short-term downward pressure on prices. If you'll turn to the performance summary, page 2 of the report, I'll go through the performance numbers for you. Total NAV was about $6.5 billion. The portfolio was about $3.2 billion of that, and the cash waiting to be invested was about $3.3 billion. The performance for the quarter was very strong. If you'll look at the gross of fees without cash line there, you'll see that the performance for the portfolio in that quarter was 6.8%, versus a benchmark return of 1.16%. So 564 basis points of outperformance over the benchmark, which equates to just under a 6x when compared to the benchmark. The reason for that is the infrastructure sector of the portfolio was up 12.56% for the quarter. Energy was up 7.05%. And even real estate, which again is starting to slow somewhat, was up 3.25% for the quarter. As far as the other returns, the one-year return for the portfolio was 15.55% versus 6.24% on the benchmark. That's a 931 basis point spread and about a 2.5x on the benchmark. Three-year return was 14.71% versus 753 on the benchmark, spread of 718 basis points, just under a 2x. Five-year returns 14.79% versus 851 on the benchmark, 628 basis point spread, about a 1.8x. So just looking at, present to 1, 3, 5 years returns, we pretty much are looking at a 15% return annually on this portfolio, which is a really fantastic result for the board and for the Permanent School Fund, and by way of extension for school children of the state of Texas. At the end of the year, about 30% of our total existing capital commitments remained unfunded. 26% of real estate was unfunded, 53% of infrastructure, and 35% of energy. This is as expected because energy and infrastructure are, of course, the two areas that we've been focused on for the past couple of years, so there would be more newer commitments that had not been funded yet in those two strategies. As far as new investments during the quarter, there was one new investment that you approved. It was an upstream energy co-investment with a capital commitment of $125 million. It was made during the quarter alongside ArcLight Energy Partners Fund 6 LP, and that was made through Capital Co-Investments 15 LLC. If you look at page 7 and page 8, we'll talk about the measurement of our allocations by asset type, and we look at this in two ways. We look at it on page 7 just based on NAV, net asset value, and looking at it on that basis, which reflects a purely invested basis, not considering any unfunded commitments. The allocation to real estate was 34% versus a target of 33%, so we're getting very close there. Infrastructure was at 21% versus a target of 32%, and energy was at 45% versus a target of 35%. So that reflects the fact that we still need to add more infrastructure assets. It also reflects the fact that infrastructure commitments typically have their capital called at a slower pace than energy. Energy typically takes their capital down faster, so that's why you have 45% energy versus a target of 35%. However, this is going to continue to change over time and become more aligned with our policy allocation targets as more of the unfunded capital commitments to infrastructure and energy become funded. If you'll turn to page 8, you'll see that if we look at the allocations on an invested plus unfunded commitments basis, the numbers are quite different. Real estate is at 30% versus a 33% target. Infrastructure is at 28% versus a 32% target, and energy a little lower at 42% versus a 35% target. So it takes a really long time for these things to shift because of the way that the capital call process works, but we are moving closer and closer to those target allocations. Looking at geographic diversification, which is on page 11 to 12, we're close to the targeted allocation for each region. Currently, The allocation to the U.S. is about 93% of the portfolio. Our target is 90%, so we're a little over-allocated, which means our international allocation is under the target of 10%, and indeed it is around 7% at this time. As a matter of fact, that will certainly improve somewhat with the addition of the GPIF 3 investment that you approved earlier, since it is a global strategy. And then looking finally at our investment manager exposure, which is shown on page 13 to 14 of the report. You'll see again on a purely invested basis, the portfolio is well diversified. We have a platform of 27 different investment managers. The investment policy statement limits the exposure to any one investment manager to no more than 20% of the total portfolio. The investment manager exposures at December 31st are well within that range. The top 5 highest exposures are to USAA Real Estate at 11.34%. It's followed by NCAP Energy at 9.20%, NCAP Flat Rock Midstream at 6.17%, Macquarie Infrastructure Partners at 5.53%, and Morgan Stanley Real Estate at 4.64%. I point out that co-investment vehicles are grouped by manager, and they're presented separately. The highest grouped co-investment exposure at December 31st was First Reserve at 8.06%. And that was followed by Intervest at 5.38% and ArcLight at 3.72%. That concludes my presentation. As I mentioned, this is a non-voting item, informational only, but I'm happy to answer any questions you may have. Again, it's a great quarter for the portfolio.
Any questions from the board this time? I think I speak on behalf of the board that appreciate the report, and again, another excellent quarter, and looking forward to even better returns.
Thank you, Mr. Chairman.
Amazing
We appreciate
work.
that very much. It's all my team.
You need to claim some credit once in a while. Even though this is a non-voting item and there's no further business, I want to recognize Lauren Ames and Skylar Stephens with the Sunset Advisory Commission as well for their oversight and their partnership over the course of their diligence. Thank you. We always enjoy having guests and visitors. And as I said before, no further business before the board at this time, so we can hereby adjourn the meeting.